Welcome to XYPN Radio, where your host Alan Moore brings you into a community of fee-only financial planners who want to profitably and successfully serve Gen X and Gen Y clients. If you're ready to get the knowledge you need from leaders in your field, learn from forward-thinking advisors, and take action on your own goals, XYPN Radio is the show for you. Here's your host.
Hello, and welcome to this episode of XYPN Radio. I'm your host, Alan Moore, and today I'm excited to bring you an interview with Jim Cullen, compliance consultant and owner of Financial Planners Assistance. Now, Jim is a wealth of knowledge when it comes to compliance, so I was excited to have him back on the show. We decided to do a mailbag episode focused on listeners' questions, and while Kitsis and I normally answer 5 to 6 questions in our unhinged mailbag style episodes, Jim and I covered over 20 compliance questions. These questions include compliance concerns when hiring an assistant, when to file your RIA registration forms when you're leaving an existing job to start your firm, how to disclose outside business activities, and a whole lot more. You can find any of the additional resources that we mentioned during the episode at xyplanningnetwork.com/78. In addition to the typical resources, you'll find a link to our recently launched book, co-authored by Kitsis and myself, titled The Monthly Retainer Model: What It Is, Why It Works, and How to Implement It in Your Firm. This month's episodes are brought to you by Financial Planners Assistance, providing compliance services to financial planners and other investment advisors since 1982. Financial Planners Assistance is a boutique consulting firm that provides the personalized compliance services firms are looking for. I actually personally worked with Financial Planners Assistance when launching my firm back in 2012, and I cannot say enough great things about their team and Jim Cullen, the owner. The awesome service and support I received was unparalleled, including going through an audit by the state of Wisconsin. Check them out at financialplannersassistance.com. Also be sure to go to xyplanningnetwork.com/VIP to join our private group just for XYPN Radio listeners. You can interact with other listeners, ask guest questions, and more. Without further ado, here is my interview with Jim. Hey, Jim, welcome back to the show, man. Thanks so much for being on.
Thanks for inviting me back.
So for any listeners that have not gone all the way back in the archives, you can go back to episode 25, xyplanningnetwork.com/25, and hear more about Jim's story and sort of how he came to be the owner of a compliance consulting firm and sort of his backstory, and set the stage, I guess, for his areas of expertise. And so today we're kind of mulling over, what topics do we want to cover? What questions do we get from listeners? So I put a call out in our VIP group for folks to submit questions. And on average, we get 5 to 6 questions when I do that. This time we got 20. So we have lots of random compliance questions and for Jim to answer, and hopefully I can contribute a little bit as we go. But what is true to form, I did not send Jim any of these questions beforehand. So he is doing this completely unprepared, which to me is fun because I'm not the one who has to answer these questions. So thanks for playing along, Jim, and being a good sport about it.
Not a problem. In full disclosure, I have a team about 30 people behind me ready to crack the books.
They'll be editing this show afterwards going, no, we can't say that. So, okay, here we go. So question number 1, can you maintain compliance to a fiduciary standard with clients on a monthly blog subscription model? So I guess basically the question here is, can you be a fiduciary while you are basically doing monthly retainers? So obviously we think so because we have a whole network built around this, but do you run into any issues with folks with monthly retainers and staying compliant with state regulators?
So I guess to start with a fiduciary question, the fiduciary levels apply to the firm itself. It doesn't matter what services you're providing, just from a legal standpoint, not whether or not you're acting in the best interest of the client. But you could have an RIA that has a side business of selling hot dogs, and you'll be a fiduciary to everyone eating your hot dogs. So you can't really parse it out like that. But yeah, a monthly service, you can definitely be a fiduciary. Some states that are a little bit concerned about it, they usually like to see you spell out your service offering so that it's clear that the client's receiving some kind of advisory service or service in general throughout the year, rather than you just do some work and bill them monthly going forward, unless you're like splitting up a big financial planning fee. But hopefully that answers the question.
Yeah, it's a fair point that kind of two pieces that we see with this with XYPN Network. One is that some states hate the word retainer because they apply the way that attorneys work on retainer to the way that advisors are working, they're very different. So an attorney typically takes on a $5,000 retainer and they basically bill against it hourly until that retainer runs out. So some states look at this and they go, well, this isn't a retainer at all, and they don't like it. So what you can do is, instead of calling it a retainer, call it a subscription. So that's the easiest thing to do. And like you said, some states just want to see, what are you going to do for the client throughout the year? And, then kind of show it to us on how you're going to bill them monthly for it.
Right. And also keep in mind that attorneys, there's structures in place to protect the retainer. Either they have to set up a trust account or they have to set up an account with their state's bar association.
So the other thing I will add, we should have put this caveat before we even started, is that, when we're talking regulation, anytime we're talking about compliance, I wish there was a single set of rules, but there's not. So you have the SEC, who governs anyone over 100 million in AUM or is registered in more than 15 states. So you're probably over 100 million if you're to that point. And so we have the SEC, but then we have every single state has their own regulator. And some states have multiple regulators that don't necessarily agree. So we've run into this in the state of California and some other states as well, where the regulators don't necessarily agree on the rules. And so depending on which regulator you get depends on what set of rules you have to follow. So just know that anything Jim says here or that I say is a 90% answer that may or may not actually apply to your state. So the end caveat to every single answer is, and call your state regulator to find out if this is how your state does it.
A blanket caveat is that the views and opinions expressed by me on this podcast do not reflect XY Planning Network or Financial Planners Assistance, and even sometimes they do not reflect reality or common sense.
I hope that's at the bottom of all of your contracts, but it is very true on a serious note that compliance is just one of those things. It's frustratingly complex, but that's why Jim has a job and a successful business. And honestly, a lot of the reason why XYPN exists is to help navigate the compliance complexity. So with those caveats, we'll jump into the second question. I am currently employed by an RIA, and I'm considering starting my own RIA. I'd like to test the market by putting out a white paper, collecting email addresses, maybe do some ads. What can I do and what can I not do to remain compliant while still working for my existing RIA? Now, this is a super frequent question. I have a job. I'd like to start my own firm. How do I do it? So what do you normally advise, strictly compliance speaking, on what you can and cannot do when you work for a firm and you're looking at launching a new firm?
Okay. I guess there's shades of what you can do depending on what kind of risk you want to take. So the cleanest way to do it, which is also the least chosen way to do it, is to terminate from your current work and then start the registration process and launch your own firm, which will result in a gap of at least 3 months, I suspect, of employment. More than often, what we'll find is that, I guess in this case with the white paper, I'd be careful to make it clear that you're not holding yourself out as a registered investment advisor. I wouldn't bill for it, which I don't see firms really billing for white papers anyways. And then I would double check your code of ethics compliance manual with your current firm to see what their views are on business or outside business activities, and if this would fall under an OBA situation. Further, double check to see if you have a compensate or a non-compete agreement in place with a firm. That'll often outline what you can and cannot do. Overall, the most common way that I see is that someone will start the process registering their firm. So they'll either set up a sole proprietorship, which is probably the better way to go because it doesn't have a formation date on it in case there were accused of OBA activities that are undisclosed. Register or start the process with the state and then leave for the very last step, filing the U4, because the filing of the U4 will alert their current employer that they're seeking to associate with another firm. So normally what would happen is the state gets to the point where they're ready to approve the firm once the U4 is filed, and then the person would resign from their firm, U4 would be filed, and then they'd be up and running usually in a day or two.
So just to clarify, OBA means outside business activity. So for the most part, if you have an outside business, which we actually have a question or two coming up about this, but if you have an outside business, you have to disclose it on your ADV because regulators want you to tell your clients, because that's what the ADV is about, if you have any conflicts of interest. So With this question, I would say that you have the compliance duties to how's the state or SEC going to handle this. You have the legal duties to your firm based on any of the forms that you've signed, like a non-compete, non-disclosure, that sort of thing. And then you just have pure ethics. I will say that I had a different viewpoint on these types of things when I was an employee than when I became a firm owner. So when I was an employee, I would have been doing basically what this question is asking, of trying to push some content out there, see if I can collect email addresses, see if I can test the water. As a firm owner, and now maybe I'm not the best example, but as a firm owner, if an employee, one of our team members comes to me and says, "Hey, Alan, I think I want to go solo. I kind of want to go freelance. Can I start doing this thing on the side and phase out?" I'm going to be much more receptive to that than if I find out that a team member has been soliciting business on behalf of their new business instead of mine while working for me and pulling a salary. Now, I know there's a lot that we can talk about where, like, well, you were doing it in your off hours, but then there's this issue of creative energy and who are you focused on, all that sort of thing. So from a compliance standpoint, I don't even know, can you put out a white paper without telling your firm? I bet most compliance departments at RIAs would be pretty upset if you put out anything that's financial planning related without having it approved by the CCO and that sort of thing. So it sounds risky to me to go this route, but I also err on the side of being conservative with these things. I hate seeing people get sued when they try to start a business.
Yeah, and I would advise whenever this happens, like putting out material, anything like that, I advise against, because it's very easy to make the claim that you are soliciting as an unregistered entity or you are providing marketing material that hasn't been approved by the CCO. And I don't know, technically I'm a business person, but not really a business person. I don't see much, market testing with a white paper or anything. To me, it's kind of, you just have to make the decision and take the leap or not.
That's a really good point. That's kind of an aside, but a core piece that, just putting out a white paper and getting a few email addresses, probably not really testing the market. Probably have to do a lot more, which is going to cross the line, right? If you push out a website for financial planning service and you're not even registered, that's going to be an issue. So
yeah. And I guess going a little bit back to your point, the most successful changes I've seen would be either they just cut off, resign, and do it all clean, or they let the RIA know. And normally the most successful ones are ones where they're not necessarily competing with the RIA. So I have a lot of big firms, and maybe they don't focus on financial planning. They're just asset management. So they don't really see them as a competitor when they leave, and they end up usually sending business to them anyways.
Fair enough. Okay. All right, moving on. Question number 3, and this is kind of a two-parter, but they tie together. So do all owners of an RIA need to have a Series 65 or an equivalent like the CFB? More specifically, if a CPA firm with 2 owners wants to establish a separate RIA firm, can both be owners in the firm and share in the profits if only one is licensed? So what are the rules, or are they standard from across the states on who has to be registered in terms of ownership of the RIA?
No, they're not standard at all. So how you figure this out is look at your state statutes, the securities regulation, and see how they define an investment advisor representative. Some states will define a principal owner 25% or more as an IAR, and they have to be registered, and some states don't. So like the state of New York, for example, they don't consider owners IARs as long as they're not acting in any kind of advisory capacity. So it's kind of common to have like an accounting firm own an RIA in the state of New York. The owners are only compensated through their ownership in the firm itself. They're not collecting advisory fees or getting a split of fees directly. So it really is a state by state issue.
Fair enough. Because the second part of this is, can the CPA firm, which is a corporation, own the RIA, which is kind of a mixed bag question, right? Because I think there's a confusion out there that RIA is not a legal entity. You have a business entity, LLC, sole proprietorship, corporation, and then that corporation or LLC registers to be a registered investment advisory firm. So can a CPA firm or a corporation out there own another subsidiary corporation that is an RIA? The answer to that is yes, correct?
Yeah, that's definitely possible. Just depending on what the licensing requirements are, depends on the state.
Okay. So you're just going to have to look at your state regulator, unfortunately, and you're probably going to hear us say this a couple of times throughout the show. So It can be done, but this does cause issues, particularly if you have a silent owner or silent investor that says, oh yeah, I'll front you the money to start your firm, but I'm 50% owner or 25% owner. That could trigger that they have to go get registered in order to, be an owner in that capacity. You just have to check with your state.
Yeah, better to check with them early on before you get any plans in place.
Yes, please do. All right, next up, say I have a family member as a client, because this always goes well. If I make sure all planning and investment related emails, texts, and such are directed to my official business line and email, will communications with the person on personal text or emails with that person also be subject to archiving? So said another way, if you have a personal relationship with a client and you have business communications and personal communications, do you have to archive both? Or do you only have to archive the business communications?
You only have to archive the business communications.
Fair enough. Well, that was easy. Yeah, I could see this being an issue though. So, my parents were one of my first clients. And, if I'm texting my mom about Christmas dinner, do you really have to archive? Is it safer to go ahead and archive? Or you think it really is kind of clear cut that, look, it's your mother. You don't have to show me every single text you've sent her?
I think it's safer to archive, but realistically, I do not see the state giving you a hard time if it's a family relationship, as long as when you're talking business, that's clearly archived.
Okay, fair enough. Next up, does possession of client passwords automatically trigger custody?
I'd say it does not, but you have to be very careful and you have to be able to demonstrate that it doesn't trigger custody. So if it's a password to like a 401k site and there's no ability to move money out of the 401k plan through that login, then technically it doesn't trigger custody. So you just you'll want to go through all of your logins to determine. It's not my preferred way to do things. I think it'd be a lot cleaner to go to the TPA or whoever to see if you can get an advisor login. So you'll have a separate login. But technically it doesn't trigger custody, but it is something that the state regulator more than likely would ask you about during an audit, and you should have a good answer for them.
Yeah, with my first job, so this would have been 2011, this was actually my job, was to go through, because they had just released the ruling or
the custody update, yeah.
Yes, there you go. That if you had certain controls inside of a 401k, it triggers custody. So remember, and correct me if I'm wrong on this definition, but custody is basically the ability to control the money. And basically it's, can you steal your client's money or not? That's really what they're looking at. Do you have enough control to steal? And so when I went through, I had to see, I had the ability to change the address of record without signing anything. So inside the 401k, can I just go in and change the mailing address? And then can I trigger distributions to that address? If either of those were true, then we were deemed to have custody. We had to step back. Is that a SEC thing, a state thing? Kind of where does that rule fall?
That's an SEC thing, but the majority of the states have also adopted that. One area that the SEC and the states disagree on would be invoicing for fees. If you're deducting fees from the client account, the SEC doesn't require an invoice sent as long as it's shown on the quarterly statement or monthly statement. You have authorization to do it and all that, whereas most states require invoicing.
Fair enough. So that's if you're deducting investment advisory fees. Each state has different invoicing requirements. Like Colorado, you have to send something 7 days before, 10 days before fees are deducted. Other states, you just have to send an invoice after the fact. Is that accurate?
Yeah. Then like Texas, you don't even have to send an invoice.
There you go. So check with your state, as always.
Yeah. And it is related, but it's kind of an area called, or I like to call theoretical compliance, where I have a client that does a lot of 401k business and he has logins, but to avoid custody, has a one-page kind of like a little contract that basically says he will not move money out of the accounts, and he has clients sign it. He was audited by the SEC shortly after, and they were fine with it. So that's kind of an area where that's possible way to get around it, but I'm not totally comfortable with it because we could have just gotten a very lax SEC auditor.
Sure. No, that's fair. And really the question is, why do you need the login? Usually two reasons. One is to trade, and the other is to just get the data so that you can feed that into your performance report. so that you can kind of show over, household performance. And you can use a program like By All Accounts, Blue Leaf, Yodely, Cash Edge. Like there's so many programs out there now that will pull that data in. It's better to just pull that data and then let your client know, hey, in the meeting, let's go in and do the trade instead of, I understand that sometimes clients don't go in and rebalance the way that you want them to, but better safe than sorry on that, because triggering custody. So maybe I'll throw in a 5-point B question. Who cares? Why do we avoid custody? What's the big deal about it?
Well, so number one, if you have custody of the account, you'll have to hire an accounting firm to conduct a surprise examination once a year, which gets expensive. Number two, a lot of states have higher net capital requirements for firms with custody. So I want to say like California, I think it's like $25,000 they need in their checking account in order to do it. So custody is an area that you really don't want to get nailed on without being compliant.
Yeah, fair enough. Yeah, custody, we talk about it as if it's this huge scary thing. And it's because it kind of is. You just don't want to have to deal with it. It's easier to not. Very few firms that I'm aware of, maybe you can look at, thinking through your list of advisor clients, the number that actually take custody has got to be a small percentage that do it willingly. It's just such a pain. So,
yeah, it's pretty small. I'm thinking of my clients, it's either they have a hedge fund or they're high net worth and they are, they do like family office kind of stuff.
So it's worth having that control, but also having to pay for someone to come in and be sure they're not stealing clients' money. All right. So question number 6, are there limits on the value of gifts an advisor can give to a client in a calendar year, such as sporting event tickets, holiday gifts, etc.?
So technically there's not a hard limit like FINRA has the $100, which they're trying to increase. Unfortunately, gifts and entertainment kind of fall under the fraud provision, anti-fraud provision of the IA Act. So basically what it means is that you can't give any gifts or receive any gifts that will create a conflict of interest that will put your fiduciary status in jeopardy. So normally the big ones are, TD Ameritrade takes you to wine and dine so that you send them business. Stuff like that you want to be careful of. Client gifts, you want to be careful to not make them feel beholden to you, although that could just be more of a personal opinion of mine. Client gifts, usually the deficiencies around them that I see is that they have a gift and entertainment policy, but they're not tracking their gifting.
So firms probably need to have some sort of policy around no more than X dollars in a calendar year, and these are the types of gifts we give, but then they're not actually tracking it to prove that.
Yeah, and I guess it's kind of a weird situation because I kind of default to not even have a gifts and entertainment policy if you're a one-person operation. If you have underlings like junior advisors, stuff like that, it's good to have those limits in place, but you just have to make sure you're tracking them. But if you're the sole decider of vendors and stuff like that, then it's really not necessary. You just have to be conscious about what you're doing and that it doesn't create any kind of conflict of interest that you can't get over.
I could see this too being an issue with referral thank you gifts. So obviously there are compliance questions when it comes to paying a referral fee, but someone sends me a new client and I send them tickets to the local NFL football game that were worth $500 or $1,000. Now we're out of gift range and suddenly we're into paying for referral range. So it sounds like that's a gray area. There's no hard lines, but probably avoid perception of conflict if at all possible.
Yeah, so that kind of gets into a different area. It's really more, are you compensating an unregistered cash solicitor? And did you inadvertently create or turn your client into an unregistered cash solicitor? So firms that usually give gifts to clients for referrals, they make it so that it's not for a successful referral. It's any referral, regardless of whether or not business comes from it. And it's usually something minor, like, a $25 gift card or something.
Yeah, keep it small enough that there's no way someone's going to refer to you for a $25 Amazon gift card. Fair enough. All right, and we have a question coming up about solicitor, which we'll cover here in a bit. So this is a little bit broader of a question. So what specifically do you think fee-only RIAs need to be doing with the upcoming Department of Labor rules, and when does it all need to be in place? So before I let Jim riff on this, we did an episode back in episode 44 with me and Kitsis talking specifically about Department of Labor, how it applies, all the dates and all of that. So if you want to hear an hour of DOL talk, and if you're not familiar with the DOL fiduciary rules and you think they apply to you, go listen to it. It's worth an hour, xyplannetwork.com/44. But kind of overall, obviously, fee-only advisors are asking you, what do I need to do with DOL? So what are kind of the bullet points that you're giving them on what's changing for folks that are already fee-only fiduciary? Do they need to be concerned with anything?
So I guess full disclosure, my associate Vadim Archipov's our in-house ERISA expert. And as a result, I've been trying to avoid any kind of review of the DOL rule that is like more than reading a quick summary. Because he's in charge of it. But basically, as it's all unfolding, we're finding that our clients that are RIA only, fee only, they're not really having much of an impact because they're already fiduciaries as an IA. More than likely, their compensation's level, so they don't have to worry about the best interest contract exemption. And it's really the biggest change is that when they are recommending a rollover from a qualified plan, that they discuss the differences between the plan and the IRA with them managing.
Yeah, that has been Kitsis's opinion as well, that the two areas you got to be careful of are rollovers, especially if you charge an asset management fee on IRAs and not 401ks. So you're encouraging them to roll into something you get paid on instead of something you don't. Some advisors out there don't charge on cash. Or a different percentage. I'll only charge you 0.5% for cash, but 1% for anything you have invested in the market. That will start to trigger the best interest contracts. So if you have more detailed questions or want to hear more about it, just go listen to that episode 44. That will probably cover the primary questions that you'll have about it. Next up, how do I determine exactly what my company should be doing from a compliance perspective? We're a Minnesota state registered firm. Is there a compliance checklist or something like that you can recommend? This is where I wish that there was a, RIA compliance book, or is there and I'm not aware of it? Like, are there any good resources out there for firms?
So there is a book that my wife got me for Christmas like 5 years ago. I haven't picked it up since I've been a consultant, so I don't know if it's any good. It's basically it was really expensive though. It was like $100 on Amazon, but it was like the RIA solution book. If you can find it in the library, probably worthwhile flipping through. A better resource that I like and that I still use to this day is the IA Act Nutshell series. It's on Amazon for like $40 or something. It'll get a lot more granular and probably more info than you really need as a Minnesota state registrant. Other than that, the states, if you go to their websites, usually they have some pretty good material. Almost every state does some kind of day educational series for IAs. If you ever get an email about that, I highly recommend going to do it. If you're set up with XYPN, you should probably have like a compliance calendar that you can go through to make sure you hit all of those points. And then ultimately, no matter if you do all these things, you're really not going to know until you're audited by the state.
Yeah, so I found the book you're talking about, the RIA's Compliance Solution Book, Answers for the Critical Questions. So it is down to $53. It's funny you mentioned this because I remember we actually read this book in college because I got my degree in financial planning. So we had a course on practice management and we actually read this book, and it was horrible for someone who had never worked in a financial planning firm to try to learn about compliance. But this is a real frustrating piece of owning a financial planning firm is that, again, it's hard to write a book because we have 52 different, folks that were answered, or 52 sets of regulators, and each state can even be different. Not all the states have all of their rules written down, and their interpretations of rules are different. I mean, we actually went through a process recently where we emailed a bunch of the state regulators that we have relationships with and just said, hey, could we get a checklist that you go through during the audit? And they said, yeah, we don't really have that. So we're like, well, how do you know what you're going to go through? And they was like, oh, we just kind of go through. Compliance is feeling currently a little haphazard from the states. And I know that they know what they're doing. They're being sure that advisors, A, are not stealing money from their clients, and B, for all the rules and manuals and compliance manuals and stuff that they have, are you actually doing what you say you're doing in those compliance manuals and procedures? If so, then you're good. Well, it's hard to get a checklist like that. So, to your point, we provide a lot of these resources. Obviously, you do for your clients, other organizations do, but it's hard to find free resources or cheap, just a book out there to read. And you, like I said, call the state regulator, see what they have available. But a lot of times they're just going to say, yeah, we really don't have that for you. So,
yeah. And I guess if you want to kind of get an idea of how you're doing, I would take a document request list from a state. I think a good one is the state of Illinois. It's pretty consistent from what you'll see from other states. And it's like a 10 to 20 list item. If you can go through and able to produce whatever they're asking for that applies to your firm, then that's usually a very good indicator of how the audit will go. And as far as audit goes, if you give off the impression that you actually care about compliance, that's usually a great step in the right direction, because you wouldn't believe some of the firms that these people are auditing.
That's a really good point.
Yeah, so the fact that they're asking this question and they feel like they're not meeting their compliance needs is usually a good idea that they're actually doing well for compliance, because my worst clients are the ones that are confident on their compliance program.
All right, fair enough. Which actually kind of feeds into the next question, which is, what are the odds of being audited by a state and how can we prepare for an audit? So each state's different, right? In the frequency that they audit. Are there any general rules of thumb for how often states audit their advisory firms?
Depending on the state, some states like to do an audit within the first 6 months of registration, which I think is very good, because that's early enough to where you're not setting any bad habits. And it's also an introductory audit, so they're not going to beat you over the head over anything. They're going to give you a lot of advice on what you could be doing better. It's not a very punitive audit. Some states, they usually are between 2 to 3 years between audits.
I believe states actually audit more frequently than SEC. I think SEC only comes in once every 10 years, which has been part of the complaint there. But what you just described was exactly what I experienced in Wisconsin. They came in 6 months in. They were super helpful. They were there to just be sure I wasn't doing anything stupid, check my records, be sure I was tracking what I needed to. And I will tell you that when there was something that they said, hey, it'd be good if you tracked A, A, B, and C, it's a lot easier to rebuild that after 6 months than after 2 or 3 years. So them coming in early was nice. But after 3 years, I got the letter again. What was funny about my first audit was I did not know that they were going to send me an invoice after they were done. They, take up half of the day with me sitting in my office, and then they send me an invoice for a couple $100s for the audit, which I just wasn't expecting, which was always fun as a new business.
Yes, some states will bill you. The SEC does not.
So, and then the question of how do you prepare for an audit, from my experience, they will send you a letter that details, like you said, 10 to 20 things that they're looking for. Please have, sample financial plan, show us your books and records, where are all of these various things kept. And you just have to be able to show all that. So they'll actually send it to you before they come in. Sometimes you can get that list from the state beforehand. My experience has been you need to be in a group like NAPFA or XY, and other advisors will share you their list, because sometimes the auditors don't send them until they're basically coming in for an audit. We also have a blog post that we wrote recently on how to prepare for an audit, kind of how to do a mock audit, because those are extremely time consuming to do a mock audit. So, but I don't know. I just feel like we get a little hung up on things like this, that it's this big scary thing. And in reality, the auditors are not there to shut you down or to be a jerk. They're there to be sure you're not stealing clients' money. And if you look at it through that lens, we should be glad that they're coming in and auditing us. And yeah, it's kind of a pain in the ass for the day, but okay, it's a half day, it's one day, and then you're done. You fix a few things and move on. I don't think they're as big of a deal as sometimes we make them out to be.
Yeah. And it also helps if you have a relationship with them. So more than likely, you won't have a relationship with them until the first audit. And when they come in, more than likely, they're going to be a little cold and standoffish. And from their perspective, they don't want to get any kind of, they don't want to develop some kind of relationship with you and you turn out to be running a Ponzi scheme. So normally, as the audit progresses and they realize you're not running a Ponzi scheme, then they kind of loosen up.
Good to know. That's funny. Okay, next up, what are some compliance things to consider when using a co-working space? So this is obviously becoming a little more prevalent that, advisors don't just want to go get a big office. So if you're using a co-working space, are there any compliance concerns with doing that?
Yes. So Just last month, I was in New York City auditing a number of clients, and out of the 5 firms I visited, I think 3 of them were in co-working spaces. One of them was actually a really cool co-working space that I wouldn't mind working in personally. But the things to be concerned about, number one, in the lease agreement or whatever you sign with them, you'll want to make sure there's some kind of confidentiality clause or something, because they're going to have, well, I guess co-working space, are you talking about where it's a building and you have like a little space to use all the time, or you're coming and using temporary desks or a conference room?
Probably either one, just because a lot of co-working spaces give you those 2 options with the same space. So
okay, so where you have your own dedicated space, make sure there's confidentiality clause, because more than likely they're going to have like a cleaning come through or maintenance come through in the middle of the night. You want to make sure that there's something there to protect in case they come across client sensitive data. And the other one is make sure you have a locking door, of course. And it's ideal, although not necessarily required under all state laws, to have 2 levels of locks. I'd consider that a best practice. So lock on your office door, lock on the cabinet if you're storing sensitive data on paper in the cabinet. Some of these spaces, the walls are glass, so you kind of have to be concerned, or not concerned, but aware that someone may be looking at your screen behind you while you're doing work. So that's kind of more specific to this space. But those are the main ones. And also keep in mind that if this space is your principal office address, this is where the regulators are going to come for an audit. So it'd be good to have access to a conference room or something on that day that they come.
that was actually going to be my question was, are there any issues with using a shared space for your principal place of business?
No, as long as you can easily produce the records at that space. So if you are a firm that hasn't gone completely digital and you have a lot of physical records, do you really want to lug those to the co-working space for an audit? So my clients that are like that, they usually just have their home as their principal office, but mailing address, client meeting area, all that. The co-working space is basically a branch office.
Good point. So you can have a different location as your mailing address, as in your actual meeting space, principal place of business, or even, I mean, some folks now are using virtual mailboxes. You can use that for your mailing address and have a principal place of business somewhere else. All right, awesome. So there are many vertical revenue options that seem to be increasing available for today's RIA owner, whether it be online courses, ad revenue, ebook sales. What steps should advisors take to remain compliant? And obviously, this is becoming a big question. And the next question, and actually, so we could just sort of tie these two together, is which of these revenue sources and others are still considered to be fee only? So we have the compliance side, and then we have the fee only side, which is not actually compliance. That's CFP board and NAPFA with their definitions of compensation. But what are the compliance concerns with sort of these new revenue streams that advisors are getting into?
So basically, during your state audit, they're going to look at your financials and they're going to nitpick all incoming cash. So any kind of revenue streams you have coming through the RIA is going to be subject to the audit, and they're going to want to see some kind of disclosure on the ADV about the various revenue streams. And then depending on what the revenue stream itself is, could determine where it shows up on the ADV. So like online courses, I'm not concerned about that. That's pretty typical for RIA. So item 4, you'll disclose that you do online courses. Item 5, you disclose the fees that you typically charge for it. Ad revenue gets a little bit dicier because item 14, you disclose when you're receiving compensation for giving advice to clients from non-clients. Ad revenue is not really fitting that, but it's enough to warrant some kind of disclosure that the business is getting ad revenue. So whether that shows up in item 14 as an aside or item 10 or not item 12 unless it's a BD. So that gets a little touchy. And then also, I'm not even sure if CFP or NAPFA is determined if ad revenue would invalidate a fee-only claim. Do you have any idea, Alan?
They have not. I've asked them a couple of times, and the consensus seems to be if you're getting paid to recommend financial products, so if you're running ads for mortgages or credit cards or someone else's, probably someone else's online financial course, insurance, because now a lot of the insurance companies are doing these. If you're getting ad revenue from that, that's going to violate fee only. But there's a big gray area here. What I will say, and Kitsis and I have talked about this in detail in the past. I don't have the episode number off the top of my head, but if you are, the best way to say this, the amount of money that you will make on advertisements on your blog is minuscule to the money that you will make from working with actual clients. So any ads that you run should be for yourself. And that's just from a business perspective. Don't send people to some other online course or some other, some insurance company out there. Send them, funnel them into your own kind of sales funnel and get them on as clients, because that's worth exponentially more money. The fee only definition when it comes to some of the ads is kind of complicated, but is it fair to say, not from a legal perspective, you can talk to an attorney about the legal side of this, but is from a compliance standpoint, does it make sense to put speaking revenue, book sales, online course sales, things like that in a separate company that's not your RIA, sort of a separate entity, in order to keep it separate?
Yeah, that's usually the way I go. And this is actually something that I usually get asked by either clients or prospective clients, I don't know, maybe at least 10 times a month. So my overall opinion is to only have advisory revenue going through the RIA, keep the scope directly on the RIA for an audit, and then any kind of non-advisory business you're running, run through a separate entity. So that way the separate entity or that business revenue isn't subject to like the advertising rules of the IA, like the ban on testimonials, stuff like that. So keep it as a separate entity, but then you also want to make sure that the separate entity isn't crossing the line into being an unregistered investment advisory practice. So you'll want to make sure that all the activity of the separate entity is non-advisory, non-solicitation, solicitation of advisory services, stuff like that. And then it's just really a disclosure of it as an outside business activity to you on the ADV part 2.
You bringing up just a host of compliance issues that we're dealing with because the SEC and the state regulators are just not keeping up in terms of what they issue in terms of guidance. I mean, they just recently released stuff on social media, which we've been using for, almost a decade. So this is an interesting piece. So one thing that you said was that, if it's not an RIA and it's doing some stuff like speaking or online courses that doesn't cross into needing to be an investment advisor, you don't have to follow the same advertising rules, such as no testimonials. So you have seen instances where you could do an online course or have speaking or something like that, separate company, separate website, all of that, and actually use client testimonials and not have to archive all your emails and all of that. Like it really is that separate in the eyes of the regulator.
Yeah, but it also depends on the state. So I guess a good example, I have a client out of Massachusetts who is an estate attorney, and he also has an RIA. So he has a separate website for his law practice, separate website for the IA. The IA website, no testimonials, very, not bland, but very by the book, disclosures, everything. The estate planning attorney website, there's testimonials, there's stuff like that.
Gotcha.
He had a link between the two websites, and the state of Massachusetts said, you got to get rid of the link.
Oh, okay. So completely severed.
Yeah, it had to be separate. You have to get rid of the link. Whereas I have another client in California, the exact same situation. California was fine with the link. So it's one of those areas that you won't really know until you're audited.
Okay, fair enough. So this one, again, some of these just sort of build on each other. So the question is, I know that case studies are allowed, but what specifically differentiates case studies from testimonials? So I guess let's differentiate them. Testimonials being a client says something good or bad, I guess, but probably good about your firm and their experience working with you and how great your investment returns are, versus a case study, which is you outlining what you've done for a client. Is that a fair way of looking at it, or is there a compliance definition, I guess, that we should be looking at?
There's not a compliance definition for this. So the case study, it's going to be considered advertising under the rule if it's sent to more than one person with the intention of either gaining advisory business or maintaining advisory business. So the case study will be considered marketing during SEC or a state exam. Usually what I see, generally case studies like that make us nervous, but normally what we see is that it's kind of presented as theoretical. They don't personally identify the client. They're more talking about the situation and how they helped them. And then there's a ton of disclosures you add to it.
And probably no quotes from the client. Like I could see, I helped client A and, do this with their disability insurance and save them $3,000 a year. Like this is my typical client kind of thing. But yeah, you got to be so careful. And actually, I don't know if it's still up. Kitsis recently tweeted out a link to Vanguard's website, and Vanguard very obviously is using client testimonials for their advisory service. So I don't know what rules they're reading differently than you and I are, because I wish we could use client testimonials. It's like marketing 101 is to use your clients to, propel your business forward in terms of marketing. But anyway, so sorry, Vanguard, for throwing you under the bus. But I mean, it's very clear their client testimonials, videos of clients talking about their experience working with Vanguard.
Can we discuss this a little bit?
Oh, yeah.
So I have some friends in the industry, and of course, as soon as that Vanguard thing came out, I'd get emails from them complaining about it and from clients. And I didn't really spend a whole lot of time looking at it, maybe 10 minutes. It's really more just to settle an argument. But at least the website that I looked at, pay very careful attention to how they're describing these clients, how they're describing their advisor. Like, I don't know, maybe I see the minutia just because this is my job. But the impression I got is that they went through everything with a fine-tooth comb to not violate the letter of the law, but it's kind of in an interpretive space because they don't talk about, like they loosely use the word advisor. What does advisor mean? Vanguard itself, does it mean an IAR? And then the claims that they're making are like, is that really, I don't know. It's like I'd be very interested if something comes out from the SEC about this.
Sure. I mean, and honestly, we keep waiting on some of the big players like Vanguard to do something like that. I want to know what the SEC auditor says about it, because I wish that was permissible. The anti-testimonial rules come from 70 years ago, right? Like when you didn't have social media and access to information, that sort of thing. So I would love for this to be something that gets publicly noted as, hey, yeah, this is permissible and this is why, or no, it's not permissible and this is why. So funny that you actually got some calls about that, because when he pushed that out, I was just like, well, there you go. Maybe this will start to move things forward a little bit.
Yeah, and Vanguard, I'm sure was kind of born out of pushing the regulatory envelope. So, like, if you ever are interested in it, you could go through the historical no action letters that basically built Vanguard to what it is today. And it's like a series of 20 no action letters with the SEC over the spans of like 50 years about how they're able to structure their unique structure. So
funny.
I know Vanguard isn't just shooting from the hip on this one.
Well, and yeah, wouldn't you like to be on their compliance team when somebody's like, no, really, I think we can do this. We're going to do testimonials, but they're not real testimonials. Just make it work, compliance people. And it also is good to know that you spend your free time reading no action letters from the SEC. So,
well, it was a long train trip down to New York, and I was like, I'll read on this.
Most of us sleep on trains, but all right. Next up, can you hire a business development associate with no hand in investment or planning, just recruiting clients without them having to take the Series 65 and becoming registered? So this is basically a solicitor agreement. Can you have someone who recruits clients and you pay them for that service, either salary or commission, I guess, or percentage of revenue, without them registering?
This kind of ties into that ownership question about licensing, and it really depends on the state how they define an IAR. So federally, the SEC doesn't consider solicitation of advisory clients as an IAR activity. So federal registered firms generally don't have to license their affiliated solicitors. And affiliated solicitor means that they're associated with your firm. At the time of solicitation, they have to give the client like a business card to show that they're affiliated with the firm. And then a reasonable investor or client would understand that they're being compensated for the solicitation. Whereas an unaffiliated solicitor, you have the whole solicitor disclosure document that clients have to sign. So federal level, they don't consider it an IAR, but the states are the ones that regulate IARs, not the SEC. So like the state of Florida, they don't consider solicitation activities as an IAR. So in Florida, you could have a business development person pretty much an asset gatherer bringing in, as long as they're not providing advisory services. But then like New York, also the same case. There's some states that they would have to be licensed.
So does that count if they are not employees of the firm? Like, I own an RIA and you are out there and I say, hey, Jim, I'll pay you $1,000 to send me a client, but you're not an employee. Does that fall under the same thing of, just depends on the state, or is it different if you're an employee versus not?
So when I use employee, I'm using it as defined under the IA Act. So I'm not talking about W-2 versus 1099. I'm just talking about anyone associated with a firm.
Okay.
So
okay,
it's still up to the state. So in your example, I'd be an unaffiliated solicitor. So I would have to be registered in my state or whatever state I'm soliciting in. Your firm would have to be registered in order to get that business. And then we'd have to have a solicitation agreement in between us spelling out the compensation. Then I have to have the client sign a disclosure document outlining the compensation that I'm getting.
So to be clear, if you're an unaffiliated solicitor, there's always this registration and paperwork process. If you're affiliated as an employee or something like that, then you don't have to go through that registration process, maybe?
No, not really. The main difference between affiliated and unaffiliated is the level of disclosure you have to give to the client.
Okay.
So affiliated, you just have to let them know that you're associated with the firm. Unaffiliated is the whole disclosure document. It's up to the state whether or not your soliciting activities requires you to be an IAR.
Okay. All right. Fair enough. Clear as mud. So what are the compliance implications of hiring an assistant, someone who helps with data input, paperwork management, kind of all the back office tasks, but not actually doing any advice? Do they have to be registered?
No. So compliance implications are you'd want a non-disclosure agreement with them since they'll have access to client information. You'll want to restrict their access to your systems that they need access to do their job, but nothing more than that. You don't want them going through, QuickBooks and messing up your financials or anything like that. They can't do advisory business. They can't give advice. You could consider them non-access person as far as your code of ethics goes if they don't have knowledge of any trades that you do for clients in advance. So that'll cut down the quarterly statement reporting and stuff like that.
Okay. And I remember doing this myself when I was working as a paraplanner for another firm, that it was easier in their compliance person's mind that if they were hiring an RIA and not just an IAR, meaning that they were hiring a firm that does financial planning instead of bringing in an employee, because each of those have different layers of complexity. So does the fact that someone is doing plan writing matter, or is it just who's delivering, not even plan writing, maybe I should say, let's say determining portfolio allocation, right? Like something that's very clearly investment related. Is it that they did that work, or is it that they delivered it to the advisor, or I'm sorry, to the client?
It's really that they deliver it to the client. So let's say in your example, you have an RIA and you're licensed. You hire a paraplanner that's unlicensed. They can do all the work, but ultimately you're the one giving it to the client. You're putting it through some kind of quality review control. You're the one that has your neck on the line as far as the investment selection goes and stuff like that. And the paraplanner has no involvement with the client.
Okay, so it really is who's client facing. Who are the recommendations coming from? All right, so this one piggybacks a little bit on an earlier question. So I'm at an RIA. I want to launch my own RIA. Can I register an LLC now while I'm still employed? This is the area that we were talking about earlier, where the problem with LLCs is they have a launch date. When you register the LLC, it launches, and depending on what you've agreed to with your firm as well as your state, just the act of registering an LLC may trigger that you need to put that as an outside business activity, on your ADV. And my understanding is some firms actually monitor state, maybe this would be a broker dealer, but monitors the, Secretary of State's website to see all the new LLCs being launched, to see if those names correspond to anybody at the firm. So this can be a really tricky process to get an LLC registered while you have a job.
Right. So technically, I guess not that I guess, I've seen it happen. The parent company could say you had an undisclosed outside business activity. They file your U5 and they disclose this violation, which could make the registration process with the state a little tenuous and a little bit harder. So it's really, you have to get an idea of your relationship with the firm. I don't want to give anyone any false comfort, but the only time I've seen this come up outside of the wirehouse, so they're working at an RIA, it was like a mom and pop shop, and there was just bad blood there already. So they were looking to make their move as painful as possible.
Fair enough.
So that said, some people, they'll launch as a sole proprietorship. Once registered, move it into an LLC. Each state is different how long you could, as far as a corporation licensing laws, how long it could be a sole prop and move it over to an LLC without any issues.
Yeah, the only situation I'm aware of that this tripped someone up was when they were accused of soliciting clients from their old firm. So then the old firm started looking and said, oh, well, you registered your firm 6 months ago, and then sued them for breach of, non-compete and all of that. So just be careful, and I know that the path of least resistance sometimes just isn't the best path. So, just getting your LLC up and running and then and then quitting your job may not be the best option. So just be careful.
Yeah, be careful.
I guess is the best thing I could say.
Yeah, with what information you take, you don't want to be downloading client statements and stuff like that and running with them.
Yes, they can track all of that. All right. So this is an interesting one. What would you suggest for someone interested in compliance that is outside the industry? So someone that's, looking at getting into compliance. Are there training programs, courses, law school? Like, how do you get into compliance if this is an area of interest for someone?
Yeah, there's not really a straight path at all. So if they want to get into compliance, sometimes just having an interest in compliance is enough to get your foot in the door.
Because so few people are interested, right? Like it's, for some of us, not the most exciting career path to choose. So thankfully it was for some of you.
Yeah, there's like two barriers. Number one, even knowing that there's such a thing as compliance. And then number two, wanting to do it. So those are the big things. Usually you could just go on to like, I don't know if it's still around, but Indeed.com, that was usually a pretty good website to look at compliance job listings and just see what's out there. Usually you'll have an easier time starting at a big firm in a low-level compliance position and working your way through that versus just going to like a, 100 million to 1 billion size RIA firm.
Okay, makes sense. Yeah, and again, there's not a lot of manuals out there, so I guess you could read the RIA book we mentioned earlier, the RIA compliance book. You could, read some action or no action letters from the SEC and that sort of thing. But there's really not a central resource. Is there even a organization of compliance consultants or anything like that? Do y'all do a conference or have a network or anything?
Yeah, like we have like shadow conferences and stuff like that, like in the shadows that aren't advertised. You kind of have to be invited to. There's a couple of those I go to. NRS, competitor of ours, they have I want to say it's called Investment Advisor Compliance or Certified Compliance Person certification, which is the only IA compliance certification that I know of, but it's costly and it takes a while. So I don't know if that would definitely, if you completed that program, which I think is like 2 to 3 years, that looks good on a resume if you have no on-the-job experience, but I highly recommend trying to get on-the-job experience versus everything else.
Sure. And I do know some of the companies like Reg Ed or they bought Arcovy, which we use for social media archiving. I think some companies like that host some conferences. I don't know how compliance focused they are versus, I don't know. It's a very wide open space, not to build Jim's next competitor, but compliance is a good space. It's a good business to be in if you're an expert, if you know what you're doing. Now, obviously, you can't half-ass it. It takes years to get the experience that you need to be a true compliance consultant, but it is an interesting business model right now.
Yeah, and if you go the route of law school and you kind of specialize in securities law, more than likely you'll get picked up for private fund securities attorneys rather than actual compliance stuff.
Get paid a lot more over there.
Yeah.
Fair enough. All right, next up, what compliance consequences are there to consider when setting up a service model for younger clients as a DBA within an existing firm? So this is frequently for a larger firm that's kind of doing their own thing, and they want to roll out a kind of a unique service model, client segmentation strategy, whatever you want to call it, geared towards younger clients. So you do a doing business as, you file that DBA so you can use a new brand. Are there any compliance concerns or any consequences there that people need to be aware of, or is that pretty streamlined?
I don't know if it's not really a concern. It's more of a disclosure element. So, for example, I have some clients that they are one firm, but they have an asset management wing where they do investments for like mutual funds, private funds, stuff like that. And then they have an ERISA pension consulting wing. So in that case where it's two clearly different service offerings and they're doing separate marketing, they kind of see themselves as divisions within the same RIA. So in that case, and I guess going to your example, if you have like your traditional IA stuff and then this other kind of division for young investors and you market under that, you could split up the ADV Part 2 way so that the traditional clients get the traditional ADV and all the disclosures with it. And then the young clients get a tailored ADV that only applies to services they're getting. And they could have different logos on it, different branding, as long as there's certain disclosures that have to be on both brochures that all clients get, but you can divvy up your disclosure documents if you're going to be doing divisions. Now, the issue with that, though, is that when you do your annual update and amendment or any kind of amendment, you're doing twice the work that you'd normally be doing. And you have to be careful to make sure that all relevant disclosures are on the ADVs. But yeah, it is possible.
All right. If you have a side hustle, so some sort of side job that's not related to financial services in any way and does not interfere with your regular RIA work hours, does it need to be included in your ADV? So I'm launching a firm, I'm running my RIA from 9 to 5, and then I'm a server at night at a restaurant. Does that need to be listed on the ADV anywhere?
So there's a number of places where it could potentially be disclosed. And I'll start from the most conservative on up. So the U4, any kind of outside business activities you're doing needs to be disclosed. It could even cover volunteer work. So it definitely hit the U4. Whether or not it hits the ADV Part 2A item 19 and ADV Part 2B is, does it take up more than 10% of your time, or does it account for more than 10% of your annual compensation? Which in your example, I'd say it probably does. So it would need to be disclosed.
Yeah. So 10% of time or income needs to be disclosed on the ADV Part 2. Anything that takes time should be disclosed on the U4?
Yeah. The U4, it's a very low bar for disclosure. There's a de minimis on the ADV Part 2. And it kind of goes into, I don't know, I see it as a theme that the financial industry is very employee unfriendly. And it's surprising how much they can get away with respect to employment law, like stuff that would never happen in a regular or different industry normally happens under FINRA in the financial industry.
This is basically the employers with money, and it kind of comes from the broker-dealers that have lobbied in order to get rules in place to protect their own, right? To be sure that if their employees are looking at changing jobs or do change jobs, they know the minute it happens. And if they don't know, then they can sue because they weren't told, which is a fair point. So but the U4, even RIAs, right? Like even state registered RIAs have a U4. So everyone that is doing investment advice has a U4 out there that they need to update.
So I guess everyone does have a U4 except for New York firms if they're only an IAR in New York, and then Wyoming
and New York. There you go. Like I said, beauty of state registered RAs. But now the Wyoming is changing in 2017, right? Don't you have to be registered?
Yeah, someone was telling me about that, and I don't remember who.
So I think Wyoming's coming along. So anyway, so if you're in Wyoming, which I'm sure 3 of you are, or maybe you're just driving through Wyoming on your way to Yellowstone, you may want to look at it. So final question. From a compliance standpoint, when do I cross the line from being a financial coach to being a financial planner? So this is, again, a really common question that we get where folks want to do coaching. I call it level 1 planning, where you're doing cash flow, budgeting, just, basic saving, spending habits, that sort of thing. You don't want to get into being in investment advice because you don't want to register as an RIA. So how do you avoid having to register? What are the lines that you can't cross? And is it different state by state?
Technically, it could be different state by state, but they're all pretty uniform. They all kind of take it from the SEC, which everything from the SEC, there's no clear line. It's all Supreme Court cases, regulatory releases, no action letters, stuff like that. Where I guess the simplest spot to draw the line for me is once you're offering personalized investment advice for compensation, then you've crossed the line into being a registered investment advisor. So if it's like cash flow analysis, budgeting, non-securities related stuff that you're being paid for, that's fine. But once you get into investments, then you cross a line. And it's also a very murky line. So prior to 1980 or 81, financial planners didn't have to be registered with the Securities and Exchange Commission, or they didn't have to be registered as an RIA at all. But then they determined that something as simple as you should invest 50% into equities was determined to be personalized investment advice. So I guess to contrast it, there's like those like investment newsletters you see, like Motley Fool, stuff like that, where they're clearly talking about securities, but their advice isn't personalized. They have, I think, 2 RIAs registered for the actual personal stuff if someone wants to invest with them. But if you're just a newsletter subscriber, you're getting securities analysis, but it's not personalized to your situation.
I have to dig back in the archives of my brain. Wasn't there was an acronym for folks that were exempt? It was like teachers, engineers, accountants, and educator. Let's see. So teachers was educator, teachers, accountants, attorneys, and engineers, or something like that. Am I thinking of the right thing? This is a long time ago.
Yeah. So like an accountant may make a recommendation that you do an IRA, but that's like part and parcel to their advice as an accountant. So they're excluded from the definition.
Right. Now, if they start getting in and making asset allocation recommendations and telling you to buy a stock and sell another stock, that's going to cross a line. But isn't it incidental to your work? Some do have an exclusion there. Yeah, I find that towing this recommendations related to securities is a tough line to tow, because you're talking about, well, I think you should save into your 401k, and they go, well, which fund should I be invested in? Well, you can't tell them, or they say like, well, what account should I keep my emergency fund in? Well, it could be a money market account, which could be considered securities. And then all of a sudden you're tripping into these rules. So my recommendation is, if you are talking investments at all, anything other than budgeting, if you get outside of budgeting and debt, you need to get registered to play it safe, because the last thing you want to do is have to go through the registration process because you get found out by the state regulator as being an unregistered financial advisor, and then having to go through that whole process because they may block you from doing your work in the future. So better safe than sorry.
Yeah, they may block you. They may even try to claw back revenue. It could get pretty ugly.
Ooh, good to know. Well, Jim, we made it through 20 compliance questions as well as a couple that I threw into the bunch. So I am extremely impressed. Thank you for playing along, I guess, with random rapid fire compliance questions. Obviously, these are ones that you get from time to time, though.
Oh, yeah. I get it all the time. So it's good to get it in one spot where a lot of people can download it and listen to it.
There you go. You can now just send a link to frequently asked compliance questions.
Yeah. Skip to minute 33.
Well, Jim, thank you so much for taking the time to be on, man. We really do appreciate it. We covered a lot of ground here in terms of compliance, but I hope this was helpful not only in answering your questions about compliance, but also showing you that compliance is manageable and shouldn't be the reason to not start a firm. This month's episodes are brought to you by Financial Planners Assistance, providing compliance services to financial planners and other investment advisors since 1982. Financial Planners Assistance is a boutique consulting firm that provides the personalized compliance services firms are looking for. I actually personally worked with Financial Planners Assistance when launching my firm back in 2012, and I cannot say enough great things about their team and Jim Cullen, the owner. The awesome service and support I received was unparalleled, including going through an audit by the state of Wisconsin. Check them out at financialplannersassistance.com. Be sure to join our VIP community at xyplanningnetwork.com/VIP to hang out with other XYPN radio listeners, ask questions for future Mailbag episodes with myself and Kitsis, and to finally find a community of like-minded financial advisors. Thanks so much for joining me today. We'll see you next time.
You're not alone, and you're not crazy. It's scary starting, building, and growing your own financial planning firm. And that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to xyplanningnetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.